Okay, folks, welcome to Thursday Night Stock Charts Live. Happy holidays to everyone. Happy Kwanzaa. Happy Festivus. Merry Christmas. Happy Hanukkah. And hope everybody's having a great holiday season. Let's talk about FedEx a little bit here. They're spiking after hours. Not so much on earnings per se. I don't even know what their earnings were, but I know that they're divesting their freight business. So they're unlocking value, which the street likes. So they took the shares up in the after hours session. They closed at 275 spot 88, and we have a last tick of around 300 on FedEx in the after hours. Now, my guess is we're going to get a couple of upgrades tomorrow. So I suspect that where we close this evening, we will be higher in the morning. They beat on EPS. This is their Q2 guidance. Q2, oh no, this is not forward looking. No, okay. This must be their Q2. Yes, Q2. Understood. Fiscal year Q2 2025, EPS $4.05. Beat by a mile. Strong beat. Sales, which I always look at first, except for tonight. I put more emphasis on sales than I do EPS because they can be manipulated. They beat on top line, bottom line, and they have a good story to tell. Therefore, the path of least resistance for FedEx at current is to the upside. Now, what that means for the transport stocks, I don't know. I mean, they've been decimated of late. FedEx, the outlier. I mean, really, really good weekly chart here on FedEx. Best of breed. Clearly, this chart is not reflective of the after hours price action. If I were to buy transport stocks tomorrow, it would probably be FedEx. I mean, they're really, really holding the gains they put on the past 2 years, and they're in a solid formation. So FedEx looking strong here. Would I chase it? No, absolutely not. Now, other names that are out there that are holding up well, because we're going to talk about where money is going to flow next, right? Because we have a regime change. So we went from a rate cut regime to a rate hike regime to a pause, from a pause to a rate cut regime, one of the shortest ever. And now we are back into a pause. So what worked well in that rate cut regime is not going to work well in a pause regime. So we have to keep an eye on two reports mainly. One, an aggregate of the, sorry, I just hit the pause button. We have to look at the aggregate of the inflation data, and we need to take a look at jobs numbers. How are jobs numbers holding up? Are we seeing rising unemployment? Because if we do, believe it or not, the stock market may rally. And I say may because it's indicative when you get job losses, that's indicative of recession. Now, the reason why I say stocks may rally is in anticipation of a Federal Reserve action, meaning they need to go from pause back to rate cut mode. Then the question becomes, okay, is inflation now under control after the pause? I doubt it. It wasn't under control when they were doing rate cuts. So if we're not down to 2% in a rate cut regime, and a rate hike regime, and they went into cuts that are not going to hit the economy for another 6 months, then I don't know how we go from a rising interest rate environment to a deflationary or disinflationary environment, and that poses the problem for the Federal Reserve if jobless claims pick up. If we see rising unemployment, what do? Do they address jobless claims or rising unemployment? To do that, they need to cut rates. To fight inflation, they need to raise rates or do nothing. And if they do nothing in an environment where they're losing jobs, well, it's only going to get worse. So the Federal Reserve is boxed in at this point in time. And there's other reasons why they need to be nervous, because you have a new regime coming in to Washington in January, and basically the war has already begun for the purse strings. Donald Trump is not waiting to take the reins of president on Inauguration Day. For all intents and purposes, he is acting president of the United States. So, a lot to talk about. Let's get to it. And of course, we're going to talk about the weekly charts. How do we appear poised to close out the year? How do we appear poised to open up next week? And in certain cases, how do we appear poised to open up tomorrow? So let's get to it. So for those that are just joining in, please make sure I put a comment in the... Oh, this didn't go out to everybody. God damn it, I did it again. I always do this. Oh, there we go. It worked. Okay. So this is our public forum. If you are not currently a part of the forum, it's free, no credit card required. All you need to do, sign up. Takes 2 seconds. I just posted the link in the box. And here you'll see this is where you enter your chart request, because I requested it a bit earlier. Folks, please post your chart requests. Thursday Night Stock Charts Live. And we have a few are ready to go here. My writing implement. RGTIMUUNG. Loving that UNG. Who asked for that? George. Wise man. Very wise man. Okay, Franklin. Mo. That's an interesting one. I think they closed up today. Mo. Okay. So the only time you're going to get asked for payment, folks, is if you head on over to the Bull and Bear Banter. That's our chat room. Very small fee, just enough to keep the lights on. And you get some great folks in here, great banter. And it's cheap as hell. It's pennies, just to keep the lights on. Not looking to make money here. Okay, so that's that. We're also sponsored tonight by TrendSpider, who we're usually sponsored by. Head on over, get up to 35% discount code below. Use the link below on YouTube, above on Twitter, at least 35% discount. Take a tour, head on over. I will be doing a demonstration. And as a matter of fact, I'm going to be doing a demonstration in a moment of ARM Holdings and why I am going to be bragging about taking a loss. I'm going to brag about it because that's the attitude you need to have. We'll talk more about that in a moment. Let's say hello to folks. George, welcome. Mr. Tim, good evening, Bob. It seems to me the moment money is coming out of speculative plays. Is that right? Bingo. It all goes back to the regime, right? So the markets are cyclical. In a rising interest rate regime, which is what we've had, what did well? Mega caps, Mag 7, they did well. Why? Because they don't have to go to your local bank and take out a loan and pay a rising VIG. They can issue debt, they can issue stock, they have cash. So they're not as interest rate sensitive as are the mid caps, the small caps, the high flyers, the big beta names. So there's a lot of froth that can come out of this market in those names. As a matter of fact, in general, on the S&P 500, we'll go to the valuations in a moment. A lot of even the Mag 7 names need a pullback. They're very expensive. So yeah, the money is coming out of those names, and rightly so. Now, does that mean that there's not going to be an opportunity before the next Fed rate cut? There's going to be definitely an opportunity. If you see jobless claims pick up, that may be an opportunity. It may be an opportunity. The only reason is because we have to take the pulse of the market and say, okay, is the market more worried about a recession, or are they more optimistic about interest rate cuts due to bad news is good news for the stock market? As sick and perverse as that is, I didn't make it up. It was like that when I got here. Right? The Wall Street loves bad news because it puts the pressure on the Federal Reserve to cut cheap money. The problem is we have a new regime in Washington, D.C., and there's a lot of concern about what is next for the economy. You have a budget battle going on right now. I should say not a budget battle. There hasn't been a budget in years. You have a continuing resolution of spending battle going on right now. And it's interesting to see the spineless jellyfish of Republicans that are out there that are just, they're becoming dinosaurs. They are dinosaurs, and they don't realize it yet. Franklin, good afternoon. Thank you, sir. Appreciate that. Jody, welcome. Corey, welcome. Good evening, Bob. Don't know which way to go on my large position. I took on gold last year. All right, so I never lightened up on gold. That's due to the fact that I own the physical, and it's just a pain in the neck to exchange it. We did own options for a time. Most recently we traded a futures contract off of gold's prior low. It rallied, we sold it, and gold is now back under pressure. This is not the environment where you would want to go buying more gold, unless, of course, you're looking to build on your position. I think you're going to get better prices because right now the bond market is doing the job of the Federal Reserve. What does that mean? It means that ever since they cut rates, bond prices have tanked, bond yields have moved up. What has that done to gold? Gold peaked out in August, I believe, September, and it's done nothing but trend lower. The gold stocks, which we sold half of our position on, right near the top. I mean, literally one day off of the top. We booked half profits, went to cash. I'm still not ready yet to go buying back in. I think we're going to get better prices. When might that be? We'll talk about it. But as long as the US dollar continues to grind up higher, that's going to pose a problem for gold stocks because they trade inversely. Gold trades in general inversely. When is that not the case? It's not the case when you have geopolitical risk. When was the last time that gold rallied along with the US dollar? That's when Israel and Iran were swapping missiles. That's over with. Israel won, Iran lost. Syria's fallen. So a lot of the concern out of that area of the world is leaving the market. What else is going to be coming to an end soon? The war in Ukraine. Thank God. All those poor people, both sides, Russian, Ukrainian, dead for what? Nothing. Nothing. They had a peace deal on the table. The British blocked it from being signed right at the beginning of the war. The West wanted this war, and all these people are now dead. So I hope that a peace comes there soon, but the problem for gold is that that's another risk that's off the table. World War III, hopefully we don't get it, is coming off the table. China's still out there, not really concerned. They just put in a bid to buy a whole bunch of Boeing jets. So obviously they're sending out a fig leaf to the Trump administration. We want to do trade. So I think the geopolitical tensions they're just going to go down. There's no money to be made except if you are in the arms business to be made on war. The banks make money for lending money out to finance the war, and the arms industry does well because they need to provide weapons for the war. And you could argue healthcare does well, but in general, it's just not really a great thing for anyone, right? So I think that I'm more optimistic than I am pessimistic going out a year from now. I think that what we're looking at right now is an environment where you have a lot of indecision, and the markets do not like indecision. That's why they're always seeking guidance from the Federal Reserve. Does RFK knock the poop out of the food companies for putting red dyes and all this junk, all these preservatives and toxins into our foods? Maybe, maybe not. You know, it's right now it's a hope, and that's it. It's not a reality yet. Does pharma get what it's got coming to them? We don't know. All right, so those names you want to avoid right now, and then revisit them when there's blood in the streets. And we have a couple of sectors out there right now that during a pause regime, and you're looking at a interest cut regime coming down the pike, you got to start looking at energy. You got to start looking at growth stocks. We're not there yet, but energy is looking very, very interesting. In fact, we began bull operations on energy only a few days ago, and we put on a cash flow strategy, what you call an iron condor on XLE, which is getting beaten up. It'll probably continue to get beaten up, but I think we're very close to a bottom there. And I think I'm more optimistic than I am pessimistic. I just think that we played it right. We knew that stocks were expensive. I come on here twice a week. We've been saying stocks are expensive. Trailing stop losses. A lot of them should have been fired off already. So, and I had to get booted out of one yesterday. Not a big deal. It's not, you want that capital. You got to have your dry gunpowder because there's great opportunities that are going to be coming up. The money is made on the buy. And right now is not a time to be initiating new long investments. Swing trades, momentum trades, sure. But that's done now. That's over. Right now, it's a new environment. We got to trade a bit differently. We want to preserve that capital. We want to go back to what we were doing during the bear market, and that is cash flow strategies. More short positions, more balanced approach. Will we have long positions? Absolutely. I want stocks that have been beaten up and didn't do well during the rate cut environment. One name in particular, Boeing. Boeing is doing great. We're up 16% on it. It was up yesterday. It actually closed down yesterday, fractionally closed up today. And I think it's going up higher because now it's under institutional accumulation because nobody wanted it. They have new management. Their production facilities are back open again. They have new orders coming in. You want to look for companies that have been beaten up and they have something new going on, new management, new products, etc. And they're not frothy. So I'm more optimistic than I am pessimistic. Now, in keeping with what I began this with, and that's taking losses. Right? Take your goddamn losses, please. Here's an example, okay? Here's one. You have a lot of YouTubers that come on and they talk about all their winners. Oh, they're winners. I got to sign up for their newsletter. I got to watch them every day. They never lose. They lose. They just don't talk about it. So ARM Holdings, I spoke about this one, I believe, on Sunday night, and it broke out. It pulled back, did a retest. We opened up a one lot, the smallest call contract size you could put on, a one lot call spread, meaning I bought a 70 delta call option, sold a 30 delta call option. That helps finance the trade and it helps hedge your risk. So The next day, it pulled back, it rallied off the lows. Okay, we'll give it a little bit more room. Yesterday, took out the prior day's lows. First out, best out. We took a loss, and it never feels good to take a loss. But I'll be honest with you, that short-term pain of pulling the sell, clicking the sell button dissipates like this in a heartbeat, because now that stress is off your back. Now you have capital. You have less risk, more capital. And when you wake up the next day and you see that, oh boy, the stock is down yet again, and it validates what you did the prior day, then your confidence as a trader builds. There's no shame in taking a loss, especially a small loss. The shame is realizing I should take a loss and hoping that it comes back, especially if you're long of call contracts, which is what we were. I had no room to wait. You got to make that decision and get out. My edge was gone. You always have to ask yourself, why did I get into this trade? Okay, I got into it. We had a Bollinger Band squeeze setting up here. The path of least resistance for the stock is to the upside, strong fundamentals, and the moving averages were stacked positive. We broke out. I waited for the breakout. I did the right thing. I waited for the pullback and a retest of the breakout point. I did the right thing. Didn't break a rule. I bought late in the day. Good stuff. And it didn't work out. Didn't work out. The equity markets buckled. You stopped out. Did the right thing. So if you took a loss this week and you stopped the bleeding, bravo. Congratulations. Because there's probably more pain to come. Polish Taco, Merry Christmas to you, my friend. Thank you very much. TZ Burton, welcome. Oh, boy. Oh, boy. We have a whole bunch of Polish people, great people. I was great friends with the Cuzways when I was a kid. A beautiful girl, Karen Cuzway, God bless her. One of the most beautiful women and the nicest person in the world, no less. She died early in life of cancer, and God rest her soul. Sorry to bring everybody down, but you reminded me of her. Merry Christmas, Karen. Bob, Doge isn't even active yet, and they already fixed the CR. Only 116 pages. Really? Is that a fact? Have they voted on it yet? Good stuff. That's what we want to hear. Now, the problem, and this goes back to the question that Corey posed earlier. If you get headlines like this, here's Corey's question. He took on a gold position. Let's pretend that Corey's question was, do I buy gold here? No, you don't. Do I sell gold? No, you don't. It's headlines like this. When you go from a continuing resolution from 1,500 pages down to 116, the dollar is going to go like this. Not like this, this. And the good part is that if the world sees that all of a sudden the United States has gone from ridiculous spending with continuing resolutions to sound fiscal policy, guess what? You don't need to wait for the Federal Reserve to cut rates. Why? Money is going to come in from overseas. Excuse me. They're going to come in from overseas and they're going to buy our debt because it's safe and it's yielding a positive return. Can you do that in Japan? No. You cannot do that in Japan. Can you do that in Europe? Yeah, but Europe is a basket case. If you think that the economy here is bad, you ain't seen nothing yet over in Europe. They have totalitarian. In Britain, they're putting people in jail for free speech. They're doing the same thing over in several other EU countries, and they're coming close to it in other countries. So what are they doing? What really are they doing? Are they helping the economy by stifling conversation? No, they're stifling innovation. They're stifling their own economy because nobody's going to want to talk for fear out of upsetting somebody and going to jail or being canceled or whatever they do over there. Where here in the United States, you have an incoming government that is friendly towards free speech. They want a more disciplined fiscal government. They want to cut the pork. They want to cut the size of government. Well, then, where does money flow? Just take a look at Argentina. They did it. They went from 25% inflation rate down to 2%. So the world is going to see what's happening here, the sanity that is being implemented, and money will flow into our bond markets, and you don't need the Federal Reserve. Bond yields will drop on their own. So take your losses. I think that we are still quite expensive. We'll talk about that in a moment. TZ Burton kind of, let me see if they refresh this. They do update these. Okay, so they did. Hell no, Democrats throw mega tantrum over Musk-Johnson funding deal. Well, that means it's a good deal. In what comes as a surprise to nobody, Democrats want their pork. And they have said hell no to the massively reduced spending package that Mike Johnson rolled out after conferring with the Trump team. This is what I mean. They're not waiting for Inauguration Day. Winners don't wait for Inauguration Day. They're already doing the job. They're acting as if. We really don't care what the rhetoric is out of the left. Anything new out of this guy? This guy better grow a spine. He's a decent person from what it appears to be, but he's got no spine. All right, so it appears as though we're getting closer to where we want to be. But again, what does this mean for the dollar? It's going to go up. Do you want to buy anything that trades inversely to the U.S. dollar? No, you don't. Now, what if yields drop because money starts floating into our bond market? Can you buy technology? Yeah. As long as yields are going down. And this is why we got to get it under control. Here's Social Security spending rising. The first thing they're looking to do is to cut this. I would be a millionaire 6 times over with the money that I have put into Social Security. And they have so I don't even know the words to say. If they were fiduciary, they would be jailed for their performance with the money that's been put into Social Security. So how dare they even say that they're looking to cut Social Security for anybody? How dare they? Do I believe that Social Security should be phased out? Yes. Let the people that are young people that have been robbed because of all the deficit spending, let them get that money back. If you want to take out debt, take out the debt to finance Social Security until the recipients are dead and in their graves. Let the young people have Roth IRAs or IRA funds. Let them invest it on their own. Let them do their own thing. They'll be far better off. Get rid of it. Phase it out. Get rid of it. But right now, Social Security is a huge, huge percentage of our budget, and debt. Think about it. Debt is larger than defense spending. We knew that. It's bigger than healthcare spending. They have to do something about this because this only gets worse. And the reason why they need to clean house in Washington is to do exactly what I said. They need that foreign capital that was going into European debts, Japanese debt, Chinese debt. They need that coming into U.S. debt, not the Federal Reserve cutting rates and doing shenanigans with their balance sheet, and the Treasury doing the same. We also need tax cuts. This is from Patrick Bet-David. I thought it was pretty interesting stuff. So let me turn up the volume. I'll play this. It's pretty short, but concise.
On income? No. It's unconstitutional. Okay, great. You're right. It's in the Constitution. It's unconstitutional. Sorry we brought this up. 20 years later, hey man, 16th Amendment. What's that? We want to be able to tax your income. Are you serious? Yes, but it's small. Yeah, it's really introducing a gradual income tax with rates of 1 to 7% for people making over $500,000 a year. all right, okay, maybe we'll do this a little bit again because maybe there's a war going on because it's World War I. Yes, but it's going to go away. Yeah, of course it's going to go away. No problem. All of a sudden, they didn't go away for 111 years. Now watch this. They looked at the World War I. They said, whoa, this time around, they weren't saying anything about it. Look at this stuff, the taxes. We need another war. If we have another war, what could happen? World War II takes place. Watch this. Go back to the chart, the outlay chart. What do you notice? 1930-39, 10% of GDP. But look at next year, World War II, 28%. And it stayed above that for God knows how long. And now at 37% and higher because we officially accepted that it's okay to pay income taxes. So now they're like, wait a minute, if we can tax these guys, let's just see how much more we can collect. All of a sudden, like, dude, this is great. Use it. In 1939, only 4 million people filed taxes. Total revenue, $900 million. In 1943, just 4 years later, 41 million people filed taxes. More than 10 times. How much revenue? 13 billion. 2 years later, 43 million people filed taxes. The government all of a sudden raised $45 billion. And they sat there and they said, this is brilliant. They're no longer bitching about it, guys. They have accepted the fact that this country got started fighting taxes. They forgot about their own history. Look at this. This is awesome. Let's keep taxing them. What a great program. What's another program we can come up with? Dude, how about we do payroll taxes? That's genius. Payroll? Yeah, payroll taxes. So you mean like their money is going to be taken out of their, before they get the check, they're paying payroll taxes? There's no way they're going to agree to that. Trust me, they will agree to it. There is no way. Dude, they're going to be okay with it. Do it. No joke. Yes. Alternative minimum tax, 1969. They'll be okay. At this point, they've accepted taxes. They'll be okay. Just put it on. Tag on more. Go ahead. Do more. Do more. Do more. Keep doing it. They're not going to complain about it. They're going to figure this thing out. By the time they do, they're going to be in so much debt that they're going to accept the fact that they have to keep paying taxes. And that's today. You want to put taxes on income? No. It's unconstitutional. Okay, great. You're right. It's in the Constitution.
Okay. So I think it's a great synopsis that he lays out here. And, you know, it teaches you a couple of things. One, the government, they start small. They have time on their side. Their goal is to get their nose underneath the camel's tent, stay small, and then as time goes by, normalization, and all of a sudden, you know, nobody remembers a world where there was no taxes. But what they never want you to learn is that the most rapid growth in the United States economy happened prior to the implementation of an income tax. That was the heyday of the U.S. economy. Could you imagine if they did a flat tax? Could you imagine if they did away with the alternative minimum tax? Now, I got hit with the alternative minimum tax. For those folks that are not familiar with this, alternative minimum tax, my accountant literally congratulated me. This has got to be about 20 years ago now. And he says to me, congratulations. Because I was expecting, I was under Bush. It was under Bush. I got a tax cut because it was a tax cut year. He goes, no, not you. Congratulations. You are now part of the alternative minimum tax. What is that? Well, if you make household income $150,000, I believe, or greater, you have to pay a minimum amount of tax. You can have all the deductions in the world. You got to pay a minimum. And it's not. They implemented that, as Patrick Bet-David just said, in 1969. They never adjusted the $150,000 to inflation. So they implemented it back in 1969 when if you made $150,000, it's an equivalent to you making $1.5 million today. So they were taxing the rich, but they never indexed it for inflation. So every year, more and more people get caught up in this AMT. It's the biggest scam, along with Social Security, ever perpetrated on the U.S. government, on the U.S. people, with the exception of COVID. There's so much that could be unlocked in this country if we just roll back the clock 60 years. Send us back 60 years pre-AMT. This country would be on fire with GDP. And that is what they need to unlock. Okay, so economic data this week. We had a huge miss on Empire State Manufacturing Survey. Services, that's still in expansion territory. Manufacturing, the PMI still in contraction. Retail sales, that beat. Retails minus auto, miss. Industrial production, missed by 66%. Capacity utilization, basically the measure of all of our industrial capacity. How much of it is being used? That dipped down to 76.8. Housing starts, forward-looking indicator. Sorry, not a forward-looking indicator. Building permits is a forward-looking indicator. That beat. Housing starts missed. We got the rate decision. Hawkish, hawkish, hawkish. We are on pause. Expect no rate cut in January. Let's see how far out we need to go. Last night, it was as far as June. So probability of an ease in January, 8.6. This was up in the 90s right before the Federal Reserve meeting. This picked up a little bit. March, basically 50-50. May, they're now pricing in a high probability of an ease. That was very low. This was about 50-50 last night. June was where we saw the highest probability of an ease. So they're pricing an ease now rather than June into May. Before the Fed meeting, you had probabilities of cuts going out as far as the eye could see. That is over. Now, I would argue that even though the Shiller PE ratio pulled back on the week, equities are more expensive today than they were on Sunday night with a higher PE. Why? Well, if you're a mid-cap stock, if you're a small-cap stock especially, and you got to go to the bank, and you got to take out a loan, you got to roll over old debt, guess what? You're not issuing bonds. You can't issue bonds. There's no market for your debt. You're unknown. You got to go to the bank and you're going to pay a higher interest rate. What does that do to your bottom line? Next quarter, your bottom line is going to get hurt. Why? You're paying more on interest rates. So the current valuation of the stock may look the same as it did on Sunday night, but given the adjustment of interest rates, your actual valuation has gone up. Your price to sales has gone up. So the market is still extremely overvalued. The Federal Reserve's balance sheet this past week continued to decline, but it also continues to flatline. My prediction is that if they don't cut rates and they see the markets begin to waffle, they're going to begin to buy debt and get that longer end of the maturity range, 10-year, 20-year range, 30-year range. They're going to start buying those bonds and building their balance sheet back up rather than cutting interest rates. Now, here's the problem that right now the market is focused on inflation. They're focused on the Federal Reserve not cutting rates, and they are out of control. Panic, fear. We'll go to a chart of that fear in a moment. 2 charts. But here's the other problem. U.S. labor market data is flashing red. The employment population ratio measures how efficiently U.S. economy provides jobs for people fell to 59.8 in November, the lowest in nearly 3 years. Declining ratio means the share of employed people in the United States is dropping. We've talked about this. We've talked about the U3 statistics. That's the headline unemployment rate. And then we talk about the real number, which they don't want you to talk about, which is the U6. We're at 7.8 unemployment rate in this country or higher versus the headline number on the U6 of 4.2. This is just validating what we've been talking about. And the problem is here, take a look at the lower highs and the lower lows. The trend is clear. It's defined. It is down, not bullish. So the Federal Reserve is boxed in here. What do? Now we will go to chart requests in a moment. Let's talk about how they plan on trading into the new year. Let's say hello to some folks that joined in. Trader Isaac. Unfortunately, rhinos want their porks too. Yeah, I know it. Term and age limits are needed, no doubt about it. I'm taking Peter Lynch's advice, letting go of losers. Absolutely. Very, very wise. I think the CR vote is tomorrow. Okay, good info. Patrick Bet David is a smart guy with a 1.8 GPA. That's probably about mine too. And a quality immigrant, no doubt about it. I really like him. Yeah, he's a strong guy, very solid guy. All right, we went over the rate cuts. I want to talk to you about why I believe there's going to be a rally. And as a contrarian, I see the market start to buckle. I say, really, what have you been missing here? Yields have been going up. Inflation's been going up. We have PCE coming out tomorrow. That's the Federal Reserve's favorite inflation data. What did you expect? What did you expect? 50 basis point cut? So, and look at this chart here. This is what you call the S&P 500 bullish percent index. This is a daily view, not a weekly view. RSI is at 13.25. Take a look at this bloodbath. This is a bloodbath. There is a lot of pessimism out there. This tells me that we're setting up for a rally because there's so much pessimism. Let's take a look at a weekly view. We're right at the lower end. We've pierced the lower end of this multi-year, or multi-month, I should say, trading range. Can we go lower? Sure, I guess we can. But there's going to have to be a relief rally at some point in time. So if you get if the market gets a PCE number tomorrow that's in line, I think that they could rally stocks into the new year. But then, I don't know. I don't know. We'll talk about, I have to chew ice. I ran out of water and my throat's killing me. We'll talk about seasonality in a moment. CRB commodity index. This is actually bullish. So no follow through this week on inflation. This is the CRB commodities index. So if this is moving up, that's a problem. The Federal Reserve is watching. We're down on the week, bullish for equities. Yield curve. A big, big move up higher on the yield curve. Folks, this is very, very bearish. Let's take a look at a monthly chart and to see how we're poised to close. We are right up and into this gray zone here, which is like the zone where you need to get a little bit nervous about the stock market. Because historically, once the yield curve steepens to within this zone, things can get wonky. And we are at the highs of the month. Therefore, if we close out this month, the month of December, up and into this box here in red, I'm probably going to be leaning into the short side, focusing in on our short position, which we already have on, which is the short of the triple Qs. Perhaps even the S&P 500. TLT, 20-year bond ETF. This is one of my larger positions. I park capital here to to keep it safe, and it's my worst performing position by far. But it is keeping my capital safe, I guess, yielding 4%. Let's take a look at a daily view. So they gapped it down today. This is the low. This is where I last bought. So even the tranche I bought back post-election, that's now in the red now. Now, if that CR does pass with 115 pages tomorrow, I think you could see a rally in bonds and a pullback on yields. That could keep the equity market stable. Now, here's a 10-year yield. This is what everybody's worried about. This is a weekly chart. This is a massive breakout. I mean, let's take a look at it this way. We're always looking at the trend. What's the trend? Are we putting in new higher highs? Yeah. Yeah. Forget that old trend. We have a brand new one. Massive breakout here. One trading day left to go. Tips. Broke support. Avoid. The dollar in fuego. As long as this rally continues, you just can't buy gold, silver. They're just not going to do well. It's going up. Euro falling out of bed. Europe is a disaster area. Yen falling out of bed. The dollar is the place to be. At some point in time, if we get our act together, the U.S. bond market will be the place to be, and that will take care of a lot of things, cure a lot of ills. Bitcoin, outside reversal bar on the week so far. I'll continue the dollar cost average in here, but not looking good. Volatility. Look at the breakout on the week. One trading day left to go. Up 74.44% on the week. This is fear, as is this chart here. Lots of fear. Dow Transports, crushed. The breakout has failed. What did it do today? I mean, decimated. But is there opportunity here? I mean, I think there will be opportunities here. Dow Jones Industrial Average down over 3 1/3% on the week and probably going lower. The Dow Jones Industrial Average has now had, as of yesterday, now had its largest 10-day losing streak, the largest streak since 1974. S&P 500 extended and rolling over, down 3%. What did it do today? Bearish reversal bar, resistance of 590, goes lower. How'd they close this out? 30-minute view, rounding top. My guess is we break lower in the morning. The only thing that could save this is if the market takes FedEx's news as good for the economy. You know, FedEx is up not because of their earnings per se, which were good, more so because of the divestiture of one of their businesses. This is the S&P 500 equal weight, down 4.3%. Broad-based sell-off here. Triple Qs, bearish key reversal. We have a short position here, down 3% on the week. It looks as though we are going lower. Let's go to a daily view. We have no immediate support below. Look at the volume. This is not mom and pop buying 100 shares. This is institutional distribution. And I was warning for a while about the lack of volume on this move up higher. Chickens are coming home to roost now. The equal weight of the ETF up for the Qs, down 4.63%. Broad-based sell-off. Small caps, decimated this week. This is a leveraged product. IWM, the non-leveraged product, down over 5.33%. We're probably going lower here. Next support level at around 214 per share. Volume, very heavy. The banks, an inside bar, very oversold on a daily time frame. We're probably going to pop here. I think you could sell puts here. Put on a speculative bet, short-term swing trade long. How's the weekly chart look? No bueno. Technology, wow. Wow. This is a breakdown. One trading day left to go. Maybe they could salvage the week, but right now, any close below 235 sets us up for our lower lows in the coming weeks. So be careful in technology, in particular technology. The semis. I mean, this is a nightmare. This is terrible. This is a bearish key reversal bar on the week. We have RSI with lower highs, lower lows. Stokes rolling over. This is another momentum indicator, just like the RSI. Very thin volume. I will point that out. Let's go to a daily view. Looks like we're going lower. We had a breakout point failure. This is like pretty much the same chart that we saw on that ARM position I had on. That's failed. This has failed as well. Semis appear weak. Software, I got bullish back here. I even bought it, but I sold too soon. I left a lot of money on the table here. Now pulling back. That is down over nearly 4%. Biotechs, decimated. I think you need to avoid this space until RFK gets in. Once he gets in and people think that, okay, there's as much to worry about, then you can start buying these names. I would wait until after the inauguration. Staples. Staples are one of those areas that during a pause generally does better than the overall market because it's a safe haven. This time it could be a little bit different because we have the yield curve, which is spiking up, and it's in a danger zone. So right now it appears as though we have a double top. Let's get our crayon out. Let's memorialize. There's your lower high. When is it really a double top? When we close down below the prior low of 79.36. We put in a lower low here and close there. That means that the path of least resistance has gone from up to down. Staples then become a short. Emerging markets. Got to avoid emerging markets. I think that emerging markets, once we get a shakeout in the market, yields coming down, dollar stabilizes, you want to take a look at emerging markets. Right now, no. They are much cheaper than U.S. stocks, but they are correlated with U.S. stocks. Therefore, U.S. stocks go down, emerging markets are going to go down as well. So the best bet, wait for the shakeout, buy the dip as the Federal Reserve begins to cut rates again, dollar drops, emerging markets have a rip-your-face-off rally. Energy. So energy right now is, along with the Dow transports, it's kind of saying we have recession. The yield curve is saying we have recession coming. Rising unemployment is saying you have recession coming. Therefore, what's the probability of recession? Pretty high. So am I a long-term bull on energy? Yeah. Am I a short-term bull on energy? Yeah, I think it's going to pop. Intermediate term, between 3 and 6 months, am I a bull? No, no. I'm not ready to put capital to work here. I think that they're going to get a lot cheaper once people realize how damaged the economy is. I think one of the threats to the economy, and I'm putting myself in President Trump's shoes because he doesn't want to get blamed for all the shenanigans that Biden did. One of my first phone calls would be over to the Bureau of Labor and Statistics. And I would tell them, any of your revisions that you plan on setting loose on the world next month, you release them this week. Get it out there, throw the kitchen sink at the market, let the market tank, blame Biden. These are his revisions because after a month of Trump being in office, they're going to blame Trump because it's his economy now. The market is tanking within his honeymoon period. They're not going to talk, the media is not going to talk about these are revisions from 3 months ago, 6 months ago, a month ago. They're not going to talk about that. They're going to talk about stocks being down, new president, point the finger, blame at him. That's the way it's going to work. You know it. I know it. So he's got to throw the kitchen sink at the Bureau of Labor and Statistics. I would be shocked if he's not on them right now saying, I'm going to warn you today. I may not be president, but I will be. Expect this phone call and be ready for it. So I expect a massive bearish data dump out of Washington, D.C. Oil, weekly chart. This is interesting to me. I hadn't noticed this until this very moment. Interesting. So there's a phrase I like to use, and the phrase is the market sends you signals. And you would think with the blood in the street in the oil markets this week, the blood in the street in the energy sector, that this would be a very bearish chart. It is not. Take a look at stochastics. They're breaking out with price down. In fact, price broke out last week. I'm going to bet that oil closes up tomorrow. That's my bet. I'm going to bet somebody a wooden nickel that oil closes up. We close out the week back above this line in blue. And this would have been a retest. If we get that, I'm buying energy stocks for a short-term trade. Members, be ready for those alerts. Gasoline prices, they're down. Good. We're long of natural gas. Natural gas is fire right now. Loving natural gas. And this is really a good conversation to be had here. The way our portfolio is set up right now is that we've been talking. We've been going on live streams, and I do market wrap Mondays through Wednesdays, and I do the week ahead commentary each weekend. And I talk every night about the stock market. So we knew that stocks were very, very expensive. The question was, we got to keep money active. We're going to not invest it? The answer is no. The way you set yourself up is that if you know that the market is ready for a correction, invest in non-correlated assets. So you can be long of NASDAQ stocks, S&P stocks, fine. Just don't be overly long. Look for uncorrelated names like natural gas, highly uncorrelated. And guess what natural gas does its best? When you have the yield curve going like this, moving up, bonds go up, natural gas goes up, stocks go down. Gold, to Corey's question earlier, excuse me, folks. Gold lags, but then it moves up as well because we go into a rate cut regime. Okay, let's talk a little bit about gold. Here's gold. Down 2.53% on the week. We have a potential double top here. A close down below 2,541 would mark a lower low. Momentum is measured by Stokes declining. Same thing, RSI. The path of least resistance right now, I'm sorry to say, is down for gold. Am I selling? No. Daily view. Big gap down today. I think we pressed lower here. In terms of gold stocks, we sold right back here. Half of our positions, right back here. 2 days from the top. And I was tempted to nibble back here. Didn't. Held out because we were looking at seasonality. And I knew that we were entering a seasonally poor period of time. And we remain in that seasonally poor period of time now through February. I'll go to a chart of that in a moment. But that seasonality chart on TrendSpider saved me a lot of money. We've at current, with one trading day left to go, we've broken critical support. Do we close there? I don't know. But if the dollar moves up higher tomorrow, in all probability, this is going to move lower. Next price target thereafter, I'm looking at around $42 a share to $41 per share. Then I think it becomes very interesting. Those are the junior miners. Let's go to chart requests. Okay. So we have RGTI. I think I went over this chart. Yeah, regarding computing. Yeah, this is one of those sectors that I said could be one of the next high flyers, the next Microsoft. It's in quantum computing. But as expected, it's getting annihilated. We didn't chase it. So would I buy it here on this pullback? No, no way. Not yet. Momentum is waning. All right, so I got to draw my own trend lines here. Wow, we broke support. I'm a seller here. I wouldn't short it, but I wouldn't buy it. They broke it down yesterday, retest today. I think we're going to follow through to the downside in the next couple of days. I am not a buyer of the stock. This is a daily view. Again, we broke support. Maybe they'll check it back tomorrow. Probably will. Then they fade it. If they bring it back down into this trading range or anywhere near it, I'm a buyer. MU. Big gap down on the day today, on the week, outside reversal bar. This isn't a downtrend now. It'll be in a confirmed downtrend once it closes down below. $84.25 per share. We bounced off of it today, but you have a double top weekly time frame. We break down below that support level there. You got to avoid. It's a short. It's going down. I would create an alert. Sell a call spread against it. Do anything other than buy it until it hits historical support. We'll keep it active for a month and we're good to go. Our alerts are set. Here's your momentum indicator. Lower highs, lower lows. Avoid it. We bounced off a support level today. Can we rally? Sure. I would fade the rally. Natural gas. I already went over this, but let's do it again. Natural gas showing relative strength versus the S&P 500. In fact, on a weekly time frame, we are breaking out. We have one resistance level here, horizontal, excuse me, vertical. Horizontal, we have another one we've broken out above. Path of least resistance on natural gas is up. We are long of Boyle, as I mentioned earlier. BUI. Okay, so I think there's going to be a time for this. Utilities don't do well in a rising interest rate environment. So the reason for that is that utilities are capital intensive. They need to go to the bond market and borrow a lot of money for maintenance, expansion, etc. Now, if yields are going up higher, treasury yields are going up higher, well, those are perceived as risk-free. Utility bonds are not considered risk-free. So they have to compete with treasuries and offer higher yields to compensate for the risk. So if treasuries are going up, that means the yields that the utilities are paying are going up as well, and they're always rolling over debt. Therefore, I would avoid this. I think we've broken support today on the week, and it looks as though we have a double top, which is confirmed. I would avoid this. I wouldn't short it, but I wouldn't buy it. We may get a relief rally here. We're kind of quote unquote oversold, but I would fade the rally. Do we have any more? For Franklin. All right, so the staples we know are breaking down. I love Altria, great company, but it had a failed breakout. I think at a bare minimum, we're pulling back to $50 a share. Personally, I think it breaks. Why? The weekly Stokes are already telling me I have a lower high and we're probably going lower. Momentum is really, really drifting off here and going in the wrong direction. Daily view. We have support immediately below at 52.82. Maybe we bounce, but I think, again, you got to fade that rally. And that's it, folks. If I missed some of your requests, I apologize. We're over. My throat is shot. And I'll always go over members charts. So I'll go into my vote. I lose my voice. If you're not currently a member, sign up for our 14-day free trial offer. Get TrendSpider for free with our silver and gold level membership. The version I use is the version you get. So if you have a question about, do I get whatever you're using here, Bob? The answer is yes. And in terms of seasonality, everybody gets that as well. I didn't do it much, but example, for seasonality for Philip Morris going back 50 years, that's a little bit too much data. Let's go back to 2010, post-financial crisis, January 50-50, February through April, the best sequence of months to own Altria. Make a note to yourself, add it to your seasonality watch list, that you want to be a buyer of Altria at any dip in January, assuming that the market is not in free fall. And that's it, folks. And if you're not ready yet to join our free trial, head on over. At least get TrendSpider. Get a bare minimum 35% off. Use my discount code below on YouTube. Use the link above on Twitter. CON35 is the discount code. Have an awesome, awesome Christmas, awesome Hanukkah, awesome Kwanzaa, awesome Festivus. Whatever you celebrate, I don't care. Enjoy doing it. Have a healthy one. I'll talk to you soon.